Hi everyone, and welcome to today's webinar, What's Scarier Than Halloween? Tax Issues and LLC Formations. We're both so happy to have you here. I'm Angela Hsiao, and this is my fellow attorney, Muky. Together, we're the attorneys behind Sage Legacy Law, where we help families and business owners with estate planning that protects your assets and provide peace of mind.
Yes, today we'll cover some of the most important and sometimes confusing areas of estate planning, focusing on trust, wills, taxes, LLC and business formation, and new reporting requirements under the CTA, Corporate Transparency Act.
Here's a slide about us. All right, so first, we'll start here. Trusts. So this session is designed to break things down so you can understand the big picture, but also dive into the details that matter to your specific needs. We also encourage you to ask questions throughout the webinar. Just drop them in the chat and we'll answer them at the end. First, overview of California estate planning. Let's start with an overview. First thing here, trusts are central to most plans because they allow you to manage your assets while you're alive and ensure they're distributed according to your wishes after you pass without going through probate.
Exactly. Trusts offer privacy, flexibility, and the ability to bypass the long, expensive probate process. Probate is the legal process where the court supervises the distribution of your assets, and it can take a long time and cost your heirs a lot of money.
And a lot of people confuse wills with trusts. A will only takes effect after you die, and it guarantees probate. So if you're trying to avoid probate, a trust is the better option. But don't worry, we'll explain those differences in detail. Trust versus wills. Trust lets you manage and distribute assets during life and after death. They give you control, flexibility, and protection from probate. A revocable trust is one that you can change during your lifetime. You will file taxes the same way you always have until you pass away. Until then, when you do pass away, then the trust gets its own tax ID number. This makes trust ideal for most estate plans.
And a will, on the other hand, only comes into play after you pass away, and it guarantees probate. A trust replaces most of the traditional functions of a will, but a will is still important as a backup for any assets that did not get transferred into your trust.
And let's clear up another common misconception. Wills are not the same as living wills. A living will deals with medical decisions if you're unable to make them yourself, while a will deals with how your assets are distributed. There's also something called a pour-over will, which works with your trust to catch anything not transferred into the trust while you're alive, and we call it like a safety net. So those are the misconceptions, will versus trust, and then the different types of wills as well. Tax issues in estate planning.
So now let's get into taxes. One of the more complicated aspects of estate planning. The taxes that can affect your estate include federal estate tax, capital gain tax, and income tax. In California, there's no imposition of estate tax, but estate tax from the federal side alone can be significant for larger estates.
One of the key benefits of having a trust is that it can help reduce or manage your taxes. For example, with capital gains tax, your beneficiary will benefit from something called a step-up basis. This means they'll only pay taxes on the increase in value from the time they inherit the property, not from the time when you purchase the property. We can use an example.
We can illustrate with an example.
Step basis example.
All right, here we go. So, for example, if you bought a house at $300,000 and it's worth $1 million when you pass away, your beneficiary will only pay capital gain tax on the difference between $1 million when they inherit your property and the value when they sell it, not on the initial $300,000 that you paid for. This can save them a lot of money.
And it's important to know that taxes are only filed on income generated by your trust assets. It's not just because they're in a trust you have to pay more taxes. So placing assets in the trust doesn't automatically increase or decrease your tax bill. It depends on the income these assets generate and what type of assets they are.
Mhm. Also, for your revocable trusts, which cannot be changed after they're created, they have their own tax ID number from the start. These trusts can help remove assets from your taxable estate, reducing the size of your estate and minimizing potential estate taxes.
And don't forget, there are many ways to lower taxes, such as charitable donations, spousal transfers, and using life insurance. But it's important to consult your tax and legal professionals for personalized advice to see which one fits your personal situation the best. Next, we're going on to the summary of
The
IRS
changes.
changes for 2025.
So let's do this before we get into information about business entities. It is important to address some key IRS changes for 2025 that could significantly impact your estate planning and tax strategies.
The estate tax exemption is increasing from 13.61 million in 2024 to 13.99 million in 2025. The higher exemption means that individuals and families with larger estates can pass on more wealth to their heirs without incurring federal estate taxes.
Mhm. And in addition to that, the annual gift exclusion amount rise from 18,000 in 2024 to 19,000 in 2025, making it possible to transfer more wealth each year without tax consequences. This is also a great opportunity to maximize tax efficient giving.
And another important update is that the adjustment of tax brackets for inflation, which means the income threshold for each tax rate will be higher. So if your income remains stable, you could see a slightly lower tax bill in 2025.
Mhm. There's good news for those nearing retirement, age 60 to 63. Although the IRS hasn't finalized the 2025 IRA contribution limits, they've already announced a catch up contribution. So it's increasing from 3,500 to 5,000 or 150% of however much you contributed in 2024. And for 401k, similarly, the catch up amount increased from 7,500 to 10,000 or 150% of however amount that you contributed in 2024. It offers much more room for tax deferred growth.
And next up is the Corporate Transparency Act. So this is something that people have been aware of, and there's a lot of, I feel like, fear created by this Corporate Transparency Act that we would like to address. So the
Without
CTA.
clarifying this, I think this is the scariest part of our webinar.
Yeah, we've been hearing about it for the past year, and now it's in place. So let's talk about it. The Corporate Transparency Act, or the CTA, which officially goes into effect in 2024, is a major development in business regulation, and it impacts every LLC and corporation, especially small businesses.
So the purpose of the CTA is to combat money laundering, tax fraud, and other illegal activities by requiring businesses to report who actually owns and controls the company, known as the beneficial owners. This transparency allows the government to track shell companies that may be hiding illegal activities. However, it has direct implication for most business owners.
So, what does that mean for you? If you own a business, whether it's an LLC or a corporation, you'll need to report certain information about your beneficial owners to the U.S. Department of the Treasury Financial Crime Enforcement Network, or FinCEN. Beneficial owners are typically individuals who own or control at least 25% of the company or who have significant influence over its operations.
So these reports must include personal information about each beneficial owner, such as their full legal name, date of birth, current residential address, and a government issue identification number. So if your company has fewer than 20 employees, less than $5 million in revenue, or does not operate in a heavily regulated industry, you will likely need to comply with these new requirements.
Yes, and failing to comply with the CTA can lead to hefty fines and penalties. That's the scary part that people have been talking about. Businesses that don't report this information or provide false information can face fines up to $500 per day until the violation is corrected. In extreme cases, failure to comply can result in criminal penalties, including imprisonment for up to 2 years.
And once your company has filed this information, you will need to keep it updated. Any changes to your beneficial ownership must be reported within 30 days. This is why it's crucial to stay on top of your reporting and to work with a legal advisor to ensure that you're meeting all the requirements.
Mhm. Now, how does this tie into business formation? Whether you're forming a new business or restructuring an existing one, the CTA impacts your decision making process. For instance, if you're deciding between an LLC and a corporation, they're both subject to CTA reporting requirements. And we want to reemphasize that because we've been seeing people have been coming to us and saying, oh, I don't want to do an LLC because of the CTA. It doesn't matter if it's an LLC or a corp. You have to file under the CTA. So that shouldn't be a determining factor. But there are other factors you should consider in choosing your business formation.
Yeah. When you're forming business, one of the first decisions you will need to make is whether you want to set it up as an LLC or as a corporation. Both offer liability protection, but they differ in terms of management structures, tax options, and complexity.
So, what is right for you? An LLC or limited liability company is a flexible structure that protects its owners, they're called members, from personal liability for the business's debts and obligations. It's great for small business owners because it separates your personal assets from your business assets.
Mhm. Corporations, on the other hand, are more complex, with shareholders, a board of director, and officers. Corporations have stricter formalities to follow, such as holding annual meetings and maintaining detailed records. But the benefit is that they can raise capital more easily by issuing stock, which is a big advantage if you plan to grow your business significantly on a much bigger scale.
And now let's look at taxes. So, LLC are known for their flexibility when it comes to taxation. By default, an LLC is taxed as a pass-through entity, meaning the profits and losses pass through to the owner's personal tax returns. The LLC itself does not pay tax directly, and the income is only taxed once at the owner's level.
Mhm. However, LLCs have the option to elect to be taxed as an S corporation. This can help reduce self-employment taxes for owners. In an S corp, the business owner pays themselves a reasonable salary, which then is subject to payroll taxes. But any remaining profits are distributed as dividends, which aren't subject to self-employment tax.
Yeah, and for some business owner, this S corp election can lead to significant tax savings, but it's important to consult a tax professional, as always, to make sure the setup is right for your business. For instance, S corp status comes with its own rules, like the need to pay yourself a reasonable salary and to adhere to specific corporate formalities.
Mhm. And don't forget, in California, LLCs must pay $800 in annual minimum tax, regardless of how profitable the business is. Corporations face similar annual fees, but may have different tax brackets depending on how they're structured.
Yeah, so whether you're deciding to form an LLC, a corporation, or elect S corp status, it is important and essential to understand the impact these decisions will have on your taxes and your ability to comply with regulations like the CTA.
Mhm. That's what business formation isn't a one size fits all decision. Your long term goal, financial situation, and the willingness to comply with all the requirements should all be factored into your choice. And of course, as we always say, consult your legal and tax advisors for that best path forward.
Yeah, it's not one size fits all. Please don't just take common sound bites or general informations, even like this ourselves, right? This is meant to provide information. You need to consult your professionals to make sure you're making the right decisions for your specific and particular circumstances. Next up, speaking of which, common mistakes and misunderstandings. That's for in estate planning, not in general, not in life. A common mistake we see in estate planning is that people don't understand the tax implications of their estate plan, whether it's estate tax, capital gains, and income tax. Failing to plan ahead can lead to a bigger tax bill for your heirs. And I think one of the things we want to point out is estate tax, capital gains, income tax come at different times, at different parts of your planning. I think people get it mixed up in terms of like when, how much, who pays for it, who's responsible for it. Like those things need to be clear in your mind. So you definitely need to talk to a professional that knows what they're doing and not just throwing those terms around. A lot of people hear taxes and they're scared, and then it's just like all over and like, how do I not pay taxes? It's not about not paying taxes, but understanding what and who and when and how much.
Yeah.
Right.
And there's so many different moving pieces in your life. I'm pretty sure everybody has different makeup of assets and family members. And so, that can all play a role on how you plan things out. So don't take any advice for just one part of it and think that you have to do it a certain way, because it needs to all work together.
Yeah.
So another mistake is not keeping your estate plan updated. So major life events like having children, getting married, or getting divorced, or accumulating significant assets, they all should prompt an immediate review of your estate plan. Like we just mentioned, if anything changes, you got to make sure everything else still work in sync with the changing factor. And you just have to make everything all line up together again.
Yes, it's all about alignment and adhesion to your current life and lifestyle and family situation. You have another child, make sure you plan for the child. It's not, your life is constantly changing. The world around you is constantly changing. So your plan needs to change with it. It's something that we always talk to with our client. Everything needs to match and adhere and align. If it's not, the missing pieces will go back to court. You don't want that. So the planning is about keeping everything together and matched up. And LLCs, another mistake. LLCs, while providing liability protection, does not automatically shield your estate from taxes. It's crucial to use them as part of a comprehensive estate plan. So I feel like consistent in this webinar, what's scary is not understanding, right? So to clarify things, to understand, make sure you understand, take the scaries away, and there's really nothing to be scared about, but you just manage it.
Yeah. Right? Yeah. So we've covered quite a bit today on the scary topics.
So here's a recap of some of the key points. Let's see what we have. Key takeaways.
So we talked about trust, we talked about wills and different taxes, things to consider in LLC formation and the CTA, Corporate Transparency Act. Planning ahead is always the key. So take all of those into consideration, settle down in yourself, and see where you want to take this.
I think planning ahead, adhesion, alignment, understanding, working with the right professional will always help. You should always do a meeting, because this is life planning, like we always say, and it touches on every part of your life. You need to find somebody that you could have an ongoing relationship with, an actual conversation with. You are able to communicate and understand the person. I think that's a key component, finding the right professional, whether it's your tax person, your legal person. They need to be able to work with you closely and make sure everything fits for you. So if you're interested, we're here. Plan ahead. This is how you reach us for a consultation and see if we're a good fit. And thank you for joining us. And Q&A session. If you have any, if you don't, go ahead and email us. Don't need to be shy or embarrassed. This is why we do what we do. That's why we're here. So for the next steps, email us for with your questions, contact us for a consultation.
If you contact us for a consultation, mention this webinar, we'll waive the consultation fee.
Yeah, thank you for joining us. Follow us and stay tuned for more information, and take care.
See
Happy
you
Halloween.
next month.
Bye.